Welcome to the Facts versus Feelings podcast. I'm your host, Ryan Detrick, and I'm joined by my co-host, Sonu Varghese.
Cutting through the noise in 30 minutes each week, taking out the boring and helping investors focus on what really matters. A quick note before we start the show. Investment advisory services offered through CWM LLC, an SEC-registered investment advisor. Carson Partners, a division of CWM LLC, is a nationwide partnership of advisors.
Hi, everyone. Welcome to the 32nd episode of Carson's Facts versus Feelings with Ryan and Sonu. I'm the Chief Market Strategist here at Carson Group. Sonu, your title is?
VP, I can't get over that, Global Macro Strategist.
Yeah, so we are extremely excited to welcome Sam Stovall. Sam, it's half a joke. Sonu and I got slapped on the wrist recently because we didn't give our titles in the podcast. So Sam Stovall from CFRA, just give your title so no one gets in trouble, Sam. Then we'll go from there.
Sounds good, Ryan. Chief Investment Strategist. I was at Standard & Poor's for 27 years, and then they decided to get out of the equity research business and sold us to CFRA, where I've been since 2016.
That's awesome. So Sonu and I are so excited, Sam, to have you on today. We're calling this one just Talking Markets with Sam Stovall because we're not even sure where we're going to go the next 30 minutes, but we really are excited. I mean, Sam, I was thinking, I've been a huge fan of yours for years. I think you and I have talked about this before, but I think the first time I ever saw you was at a CMT, which is Chartered Market Technician. Maybe it was called the MTA back then, Market Technician Association, in like Miami in 2003 or 4. And you were hilarious. You used a lot of jokes. And to this day, I said, you know what? I don't remember what you said. I'm sorry, Sam. But I remember how you made me feel afterward. And to this day, when I present and talk, I still kind of borrow some of those things from you. Why do you use humor sometimes when you're talking to a crowd?
Well, thank you for remembering that. I try to use humor because many times it could end up being pretty dry. So if you just keep throwing numbers out, people just get awash in that information, and I think they just tune out. So if you can try to tie it in with a little bit of humor, like talking about sector rotation and saying when the going gets tough, the tough go eating, smoking, and drinking, and that's why staples do well, then that helps people to remember.
Absolutely. Well, I know we want to kind of start off with Sell in May, Go Away. Sonu, you can kind of start it off. But again, Sam, we are so excited you're here. CFRA and Carson are great partners. I've been following you forever. Not forever. I got some other funny questions I want to ask you. But again, just honored you're with us. And Sonu, why don't we just kick things off? Why don't you start off with Sell in May, Go Away?
No, I think this is great. No, thank you, Sam. It's so great to have you on. Sell in May, Go Away. Yeah, do we go away? Or I think... I love what you've written about your 7 rules. And I think one of the rules is it's not quite sell in May, right? It's you rotate away. So, and you just mentioned should we rotate to tobacco and, stocks like that?
Right. Well, I wrote a book back in 2009 that nobody bought called The 7 Rules of Wall Street, which basically, tries to assist those investors who are nervous at heart and in a sense, allow their emotions to become their portfolio's worst enemy. So I look back at many of these old adages, a lot of which I saw in the Stock Trader's Almanac, to basically try to evaluate whether they still hold merit today. Things like let your winners ride, as goes January, so goes the year, and then sell in May. And obviously I could see why people have said that. I mean, it's centuries old, sell in May and go away, do not return until St. Ledger's Day. But when you actually look at a rolling 6-month performance for the S&P 500, the lowest return was 1.6% going back to World War II in the May through October period, but 6.6% for November through April. And the November through April period beat the subsequent May through October period more than 70% of the time. So it really does indicate that there is seasonality. I believe that there is causation along with the correlation because of capital inflows, et cetera. And then when you actually look at the data, large caps significantly underperforming May through October, ditto for small caps. And actually the MSCI EFA since 1969 and the emerging markets since 88 posted average declines in that May through October period. At first you would say, yeah, you want to definitely sell, but I say, no, you're actually better off rotating because if a lot of investment managers are paid to stick with stocks, they rotate into the defensive areas, consumer staples and healthcare. So instead of getting only 2.2% since 1990 for the market, you ended up doubling that by having an equal exposure to staples and healthcare.
Interesting. Fascinating.
That was great. I mean, I did a blog. I took a look at it. One thing I noticed, Sam, was if you're up for the year, right, these worst 6 months going into it, things do okay, like up 4% on average, higher 3 out of 4 times. It's when you're down for the year, the wheels can fall off. Like last year, we were down for the year going into these worst 6 months. Do you kind of buy into the idea that if the trend is strong going into it, it might not mean you have to rotate quite as much? Or what's your take on that?
Well, there have been several times when we ended up with either a severe correction or like in 2011, also in other periods when the market did tend to peak, either the last day of April or the second to last week in April. And then we ended up with a pretty sharp decline heading either into July or into October. So there certainly have been periods in which, even though you might have felt, oh, things are going great, I'm just going to ignore. The one thing that, because individual investors are humans, they want to overrule the rules. And a lot of times that works against them. So again, because you've done some work to say if you start off on the right foot, maybe you don't want to sell in May. And that's simply another reason why you are better off rotating rather than retreating or selling.
I'll jump in with one question. You mentioned 2011. It got me thinking. This is how I knew this podcast would go. We'll just riff on this stuff. 2011, as a lot of us remember, was the U.S. debt downgrade, nearly a 20% bear market in like 4 days. I hate to say the word famous, maybe infamous for being on TV like the Thursday before, said, oh, don't worry, everything's going to be fine. A week later, we're down 20%. But I've had some good calls too. But nonetheless, Sam, that's all over the news. Do you think we're going to have a repeat of 2011? Or what is your take kind of on the U.S. debt downgrade? Will we kick the can? I guess just yesterday, Janet Yellen said the U.S. might run out of money on June 1st.
June 1st,
faster, way before what a lot of other investment banks are saying. What are you thinking? We see 2011 again or not?
Well, first off, congratulations on your humility. This market certainly does do that, but a lot of people do engage in selective recall and only remember the times that they were right. 2011, you would think that we have learned our lesson. I think the only company that did learn its lesson was S&P, and they probably will not be downgrading the U.S. Treasury.
Oh, boy.
That's great.
And where'd you used to work again? Didn't you used to work somewhere at S&P?
Yeah, they did the right thing, and they got punished for it. Anyway.
Yeah, right.
Yeah, I think the big worry, I'm a big reader of Greg Vallieri's political work, and he puts the odds at 60-40, 60% that they will pass it, but a dangerously high 40% that they will allow us to default on our debt, mainly because these politicians want to dig in their heels and say, no, it's my way or the highway. But then I guess that's the old adage, if the opposite of pro is con, then the opposite of progress is Congress. So I think that hopefully cooler heads will prevail and that we will not end up defaulting. But you can start to see the weakening of the U.S. dollar, one reason being that probably we're close to the end of the Fed rate tightening program, but also concerns that there will be issues regarding our debt, our credit rating, if you will, and foreign investors' willingness to be invested over here.
Yeah, it seems like nothing gets done until like D-Day comes with Congress. Like they don't act, and they don't act early enough with these things.
Well, and also I find that when you look at government shutdowns going back to the mid-1970s, and there were more than 20 of them, the market did yawn. The week before the shutdown, the S&P was up 0.1%. The day of the shutdown, it was down 0.1%. And between the shutdown and the end of that shutdown, again, a minuscule move. And I think primarily it's because a lot of these shutdowns occurred over the weekend to get the vacationers really ticked at their representatives to reach out and say, don't mess up my trip to Jellystone Park.
Right. No, that's fascinating. One thing is, you mentioned the Fed. right? And one of your rules, I'm just going to read it: don't fight the Fed, at least for too long, right? So talk about, and it seems like markets, the Fed officials think, okay, we're going to keep rates high for a long time. Inflation's still above target, but the market's expecting cuts, right? And we could decide how many cuts, 2, 3 cuts by next January. Where are you with that?
I don't think they're going to be cutting this year. Our belief is that the Fed will raise, obviously, on May 3rd, but at the same time, they're likely to raise again in June and end with that final 25 basis point hike to close out the first half of 2023. And then if you go back in time, you find that the Fed waits an average of 9 months before they start to cut interest rates, which would put us into the first quarter of 2024. Now, when you put that together, you might think, I really do want to sell in May. But that's not the case. Actually, the market has risen an average of 13% in that 9-month period since 1990, when investors are anticipating a cut in Fed funds. Also, you find that all sizes, styles, and sectors, and everyone but gold on the sub-industry level, posted average price increases. So I think that the Fed will stay higher for longer. That could exacerbate the volatility and maybe put a lid on the gains that we see. But Ryan, like you, like Jeff Hirsch, like Craig Johnson, I do believe that the October 12th low was likely the low for this bear market.
Yeah, great stuff there. Yeah, we've been on record, Carson Group, saying just that very thing, that we thought October was that typical midterm year low, bear market in a midterm year low, and then everyone's been hating on the bull market since, but we think that's maybe a positive thing. Now, Sam, I will say I do see the Hollywood strike is going through with the writers, given some of the things you've said. Have you ever thought about being a Hollywood writer? If somebody comes to you, if you need to do that with some of your jokes you're using here?
Or a
What's your favorite
writer?
show, Sam? Let's go that route. What's your favorite show? What do you like to do when you unwind in the evening?
Well, actually, most of my jokes are reruns, so I end up watching George Burns, Perry Mason, Adam 12. So, yeah, no, the new stuff, I can't stay up that late.
Oh, there you go. Now, Sam, the other thing, well, the other fun one, more personal again, I've known you for years, been friends for a while. You said, you recently were remarried, and at the time, or I'm sorry, you married your college sweetheart just recently. And at the time, she was your girlfriend a few years ago, and she was feeding you good. You said she's cooking good for you. Is she still cooking good for you? And what's your favorite meal?
Well, yes, she is still cooking good for me, and as a result, I wish my portfolio were expanding as much as my waistline.
Yeah, I know.
My favorite dish is a scallop dish with pasta, calamari sized pasta. We learned about this from Gigino's at Wagner Park, a restaurant right at the New York Harbor, which has gorgeous views while you're enjoying a tremendous meal. She loved what she had, and she learned to recreate it, and I enjoy it as well.
Wow, that sounds getting hungry just thinking about that. That's great. Let's get, that was fun. Get back on task. So, although I sometimes get us off task, so I'm just as guilty. Here at Carson Group, Sam, we have more than 130 advisors, we call them our partners, growing very quickly. You've been in this industry for a while. What's one bit of advice you kind of have for an advisor? I mean, I know you've worked with advisors over the year, but one thing you can tell an advisor that can help them with their clients, or something you think that matters for a lot of the advisors to listen to this podcast?
I would say it's constant communication, being in touch with your clients, letting them know that you are there to help them to reach their goals, that you are, in a sense, helping them to buy rather than trying to sell. So really, I find that most people, whether it was my football coach from college days who said, Sammy, come on down and teach me about what I have in my portfolio, put it into X's and O's so I know what you're talking about, because my financial advisor basically says, don't worry about it, I'll take care of you. So I think really it's the communication with your clients, especially during periods of volatility. I mean, let's put it into numbers. During a bull market, only 15% of all trading days have volatility of 1% or more, yet 44% of those days are 1% or more volatile during bear markets. So a lot of investors are going to be nervous. Fear is a greater motivator than greed. So actually, you should be increasing your outreach to clients during those periods when they need you most.
I'll chime in real fast, Sonu, then go to you. So Bert White, again, our chief strategy officer here at Carson, when I worked with Bert in a past life, he said, in times of stress and times of fear, over communicate. We don't have all the answers, right? But just to let them know you're there for them, same side of the table, over communicate some of the same things and same ideas you just said, Sam, over and over and over when things are stressful. And I think that's timeless advice. That was great. Sonu, you want to fire away there?
No, I was just going to piggyback off that and what Sam said a little while ago. You mentioned the rules, and it sounds like, and Ryan does this really nicely with the charts and trying to get people to, stick to the plan, right? And how do you think about investing and especially having rules and maybe I'll put it as, systematic investing in a sense, as opposed to, just going with the fly and, doing like, somebody said this on TV or someone said X on radio, so I should do something else. And so how would you talk about that to advisors?
Well, first off, I would tell investors, advisors, just turn off the TV, turn off the radio, because
Sam, unless you and I are on TV. Come
exactly.
On,
right.
Or Sonu.
Exactly.
Sonu does some radio. Unless you hear one of the three of us, then you pay attention.
Yeah, we're the only three where they actually turn up the volume. But the reason I said that, or at least be careful about what you hear, is because the media knows that adrenaline enhances memory retention. We know where we were when shocking events occurred. And as a result, basically what they're trying to say is the world is coming to an end at midnight. Tune in tomorrow to see if it really did, to get eyeballs coming back. So you have to realize that they're going to emphasize that sensational. I did a presentation down at the Securities Industry Institute in March at Wharton School, and my topic was using stock market history as virtual Valium. Because by understanding stock market activity, history, etc., it actually can calm your nerves. And I shared with them a couple of the portfolios from the 7 Rules of Wall Street book. One of them being Who Says There's No Free Lunch on Wall Street. By using correlation, you can be surprised to know that while the best performing sector since 1990 was, no surprise, technology, if technology is the poster child for growth, what's the poster child for stability? Consumer staples. Interestingly, a 50-50 portfolio of staples and tech from December 31st of 89 through December 31st of 22 actually posted a higher compound annual growth rate than tech alone. Did so with about half of the volatility, so you ended up with a significantly higher return for risk ratio than you did not only for tech, but also for the market. So you got a superior return than tech with volatility that is similar to the market, just by emphasizing correlation between those that take the stairs at different rates of pace.
And two things that are negatively correlated, oppositely correlated, they sort of, one zigs while the other zags. Even within stocks, we usually think that happens with stocks and bonds, but even within stocks, that's a benefit within a portfolio. That's what you're saying, right?
Exactly. And if you look at the correlation between consumer staples and tech, it's not negative. It is very low, but you do know that based on consumer behavior, and even though people say to me, well, Sam, how do you look at history? Why do you pay attention to history if today is so different from 20, 40, 60 years ago? I say because there's always one constant element, and that is human emotion. And so people are going to overreact on the way down. And that's why I try to quantify the number of, the duration of pullbacks, corrections, bear markets, to let investors know that by the time you've harassed your advisor enough to lighten up with equities is probably the time that the market is getting back to break even.
I love Ryan puts it as, when everyone's thinking in one direction, General Patton's, comment, right? By the way, I'm going to steal stock market Valium. Anytime I show one of Ryan's charts and tables to someone giving historical perspective, here's some Valium for you and just calm down.
Yes, exactly.
Well, there's so many things swirling, Sam. That was awesome. The one example I've used before, maybe on this very podcast, Sam, I'm sure you have too. One of the more tragic days in our country's history was when John F. Kennedy was assassinated. Stock market did go down that day, but the next day, huge rally. And the next 6 months are one of the strongest 6-month periods we've ever seen, and one of the least volatile periods we'd ever seen, from November of 63 going out 6 months to a year, which, you think about it, that doesn't make any sense. When your head hit that pillow that evening, you probably didn't think too much about the stock market, but that the stock market's going to go up and it was not going to be volatile. So again, you look at these cycles, you look at these events, Sam, I love to do it as well, I love the way you put it, though, to show we've had bad things happen before and we've gotten through them before, and that helps calm some of the nerves. Sam, one of the questions I like to ask a lot, we've only got about 10 minutes. It's amazing how fast this is going, by the way. I love to ask about mentors. Who's one of your mentors or someone you've learned a lot from over the years, and maybe something that we can take away from that?
Well, there have been a few people. Probably the greatest mentor was David Blitzer, who was our chief economist at McGraw-Hill, Standard & Poor's, head of the S&P 500 Index Committee, and still a good friend. Yeah. I just thought early on in my career, I talk to a guy like this, he won't have any time for me. But he always had time for me. And I remember even asking him once about, I'm trying to do a beta function between different portfolios in Excel, and I really can't find the right formula. And he said, Sammy, it's a simple slope calculation. He whips out his Mont Blanc fountain pen and writes the formula. So it just blew my mind. But he was always there to help me. And at the same time, I never heard a disparaging word from him about any of my peers, even though many of them deserved such disparaging remarks. Also, Robert Hormats, vice chairman of the Energy Commission, I believe, in Washington back many decades ago. He was vice chairman at Goldman Sachs. I was the program chair at the American Association of Individual Investors in New York City. He came to speak on international investing. And afterwards I said, well, do you have any retail clients? And he said, no. And then I said, well, why did you come to speak? And he said, because you asked. And that pretty much blew me away, because here's a guy so high up in Goldman Sachs who is very generous with his time, with his knowledge, because he asked. So today I do a lot of financial literacy volunteering because of what Bob had done, but also realizing, taking that thought to heart. I've been going up to Cardinal Spellman High School for each of the last 15 years, talking to their students about financial literacy, primarily because their teacher, John Schoenberg, invited me to do so. And I said, okay.
Wow, that was great. So, guys, this is a 30-second episode of Carson's Facts versus Feelings with Ryan and Sonu. We're so delighted to be joined by Sam Stovall of CFRA. So, Sonu, we've got time for a couple more. We could go all day with this. I don't know. Sam, you want to go for like 2 hours? You just want to make this a record long one?
Sure. Let me get another cup of coffee.
Yeah, exactly. There you go. Sonu, go ahead.
Like Sam said, you have to ask, right? But no, we won't go 2 hours. But just coming back to the Fed, and, we mentioned higher for longer. We are in the same camp as well. We think it'll be higher for longer. But at some point, they'll cut, right? Maybe next year, first quarter, 2024. And usually, you see all these charts are like, oh, goodness, when the Fed cuts, it's usually because there's a recession or something like that. This time, I'm curious what your thoughts are on whether the pandemic has just overturned things so much. Like last year, housing crashed. Usually housing leads, recessions. Right, we didn't get a recession, I think, safe to say, last year. I don't think we are in the middle of one either. And now housing looks like it's rebounding. It almost looks like, oh, wait, is this the start of a new cycle? Manufacturing, look at the PMIs. It just came out yesterday. And it looks like, oh, there's a little bit of a rebound maybe, right? Maybe there's some bottoming. So some dynamics look like it's early cycle. But then, when you think about maybe it's 9 months from now, the Fed's cutting, you think, oh, wait, on the other hand, if they're cutting, does that mean we're close to a recession? So I'm curious how you think about where we are right now with respect to the economy.
Well, I do think that the pandemic has turned a lot of things on its ear. Certainly, it turned seasonal rotation on its ear because what is typically the strongest period, November through April, in 2020 ended up being an incredibly weak period. And then because we were able to get back to break even in only 5 months, that made the May through October period incredibly strong. And that carried for a bit longer, but with the midterm election year, in a sense, we sort of rewrited the ship, like the Poseidon finally turning back right side up. So I would tend to say that the pandemic probably has made some changes, but also when you look to a lot of the historical indicators, leading economic indicators being negative year on year, inflation being above 6.5%, sharply inverted yield curve, and earnings recession. All of those have been associated with recession since World War II, but obviously not a guarantee. All trout are fish, but not all fish are trout. And so while all of these have preceded recessions, they have not all caused recessions, if you will. So I think because the recession has been anticipated for such a long period of time, that I believe that we have seen sector rotation that has, in a sense, accomplished the same thing that we would normally see leading up to recession.
That's a great point. And we did have a 25% bear market last year, and more in small caps, more in technology. So, was that foreseeing some of the potential weakness this year? But Sonu and I have been on record that we just aren't seeing a recession in our view. Sam, one of the other things, mistakes happen. I made this half joke about, being on TV and a market crashed after I talked about it. But hey, news trumps charts is another one. What's some of the biggest mistakes you've seen investors make that, maybe you can shed some light to help investors avoid those mistakes?
Well, really, it's the timing of their decisions with their portfolios, and usually they're associated with emotions. I actually have had several people call me up really about a week before the market bottom to say, Sam, I'm thinking about selling everything. And so, my feeling is, well, why on earth would you want to do that? What are the factors that are telling you you should do it now versus, a while ago? And really, it's because I can't stand it. Every advisor tends to have at least one of those people who, at the top of the bull market, will say, I want to swap out of munis and go into Bitcoin. Or at the bottom, they want to say, I want to sell everything and go into treasuries, like was in the case March of 2009. So I think really what investors should be doing is saying, when a bear market or a correction comes, because it will, what should I be doing? And a lot of the things could be tax loss harvesting, could be rebalancing, could be buying some of those stocks that you missed out on the way up, whether they were growth or income-oriented stocks. Look for dividend aristocrat companies that have, very attainable payout ratios, but are now yielding 4% plus, and buy into them. Because if you're an income-oriented investor, you're really a landlord, and you want to make sure you can get as high a rent as possible, but make sure that you have a tenant that not only is able to consistently pay the rent, but doesn't squawk when you raise it. So I would say look to market declines as opportunities to approach rather than reasons to back off.
Well, that was excellent. We're probably going to end things there. I've used this before, Sam. You probably have. Maybe I got it from you. But the stock market's the only place things go on sale, but everyone runs out of the store screaming. You think about that. It kind of makes sense. But Sam, from everyone at Carson Group, from Sonu and myself, all the listeners of the Carson Facts versus Feelings, we really appreciate you taking time with us this morning to talk markets and talk all types of things. I will say my favorite thing you said, Sam, was that Congress. Say that one more time. What the progress? Say that. I thought that was awesome. I'm gonna borrow that one. How'd that go, Sam? Then we'll end it with that.
Actually, I'll leave by picking on two institutions. So
good. Let's do it.
If the opposite of pro is con, then the opposite of progress is Congress. But also because of the financial turmoil we've been experiencing recently, this is a quandary I've never been able to come to an answer with, and that is, if money doesn't grow on trees, why do banks have branches?
Oh, love it.
There you go.
Yes.
Ding, ding. That's good. All right. Well, Sam, thank you very much. Thanks to all listeners out there. That was awesome. We're going to have some fun next week. Sonu and I will be in Omaha for our annual Partners Summit with our partners, and we've got some really cool things coming. So Facts versus Feelings will be on location very, very soon. But Sam, thank you again for this week. Everyone, that was awesome. Hope you enjoyed it as much as Sonu and I did. We'll see everybody very, very soon. Take care. Goodbye.
Information provided on Facts versus Feelings with Sonu Varghese and Ryan Detrick are for general information only and are not intended to provide specific advice or recommendations for any individual. The statements and opinions of show guests may not be reflective of CWM LLC or its affiliates. Past performance is no guarantee of future results. All indices are unmanaged and may not be invested in directly. Investing involves risk, including possible loss of principal. No strategy assures success or protects against loss. To determine what may be appropriate for you, consult with your attorney, accountant, financial or tax advisor prior to investing. Guests on Facts versus Feelings are not affiliated with CWM LLC.